Interesting, but again, not surprising call out as of yesterday. You had a divergence, but locally we're starting to see divergences in terms of sector returns that are singing the same song effectively globally. So we don't want to be long of the Chinese demand component, the German demand component of industrials. We've been very clear on that. VIX, again, not quite at the low end of the risk range. You're probably going to say that this morning's inflation report, you should say, I think the market's saying it's Goldilocks. Now, Goldilocks means up for stocks, generally speaking, and the VIX could easily go to the low end of the range. The other big thing to be paying attention to is that this is the largest implied volatility discount of the year, bond yield. So you get a quick knee-jerk reaction, Darius and I were just talking about it. I think we got to, 184 at the low, 185 now on the 10-year yield. But again, this is mainly because of positioning and that we had a non-breakout in inflation expectations. Obviously, the high for inflation was last year at 2.7%. We've talked a lot about that. That's where the pink headline number got to 2.74%. So obviously 2.2 this morning is a lower high from that. Maybe that's the bond market's point, is that you could easily have the March numbers roll over from here or not go up. And that's what, of course, the bond market would consider bullish for treasuries and bearish for bond yields relative to the positioning. It's what not to do in macro that matters many times on the margin that matters most.